Good morning, everyone. Thank you for your interest in this panel. And thank you to the 5 speakers that are with me on the stage. My name is Monse Formoso. I'm editor at Funds People, a Spanish media firm. And in the next 45 minutes, we are going to discuss one of the most fascinating trends that we are witnessing in recent years, the democratization of private markets. The barriers that limited access to to institutional investors, to private markets, have been broken down. That time seems to be behind us. So making access to retail investor flexible involves the challenges and opportunities for GPs, distributors, platforms, most of them working to make it a reality. The big question is, will be the retail investors the next source of capital in private markets? Well, according to IPEM survey, the answer is yes, but we have here 5 speakers that provide clarity on that issue. So with any further delay, I would like ask for a quick introduction from each of you. If you want to start, Olivier.
Yeah, with pleasure. So my name is Olivier Domont. I'm in charge of private equity for Indo-Suez Wealth Management in Monaco. So we are the wealth management arm of Crédit Agricole. We are running a fund of fund, investing in the asset class for 20 years now, with 7 billion under management and 100 GPs.
Is this working? Okay.
Yeah.
Mike Elio, I'm a partner at Stepstone based in the New York office. I'm on the research team, co-head of mid-market, and I run some separately managed accounts for Stepstone, including our retail evergreen product called S-Prime. It leverages Stepstone's ability to deploy capital. Last year, we deployed 75 billion into private markets, so we've been quite busy.
Diana Gelotto. I'm an MD at UBS within the wealth management business. I'm responsible for the fund selection for private equity, private credit, and private infrastructure for the bank.
Good morning, I'm Wes Lockhart. I'm responsible for private markets distribution at BlackRock and EMEA, focused on the wealth and family office segments.
Hi, Tom Slowcock from iCapital. Based in London, I run all of our structuring efforts outside the US. For those of you who don't know, iCapital is a fintech that sits between alternative asset managers and the wealth channel, so private banks and wealth managers. We have $150 billion on the platform, 10 years old this year.
Thank you. Well, although this is a general knowledge, I would like to ask you, in order to contextualize the debate, what does democratization of private markets mean? Any, maybe 2 volunteers to ask this question? Maybe Michael?
Maybe I'll jump right in. I think the word democratization is a word that just makes me cringe when I hear it. I'd like to spin it the other way and say it's the institutionalization of the retail space going into private assets. Mm-hmm. I think it's a better perspective as opposed to making folks think it is truly democratic, because it is not. Access is still as capitalistic as you could possibly imagine. But I think for the retail or high net worth investor, the type of products that have emerged are much more institutional and frankly more in their best interest than what they've had access to in the past.
Mm-hmm.
I'll pick up on that. I'd say maybe 2 other points, maybe just to put it in context. I mean, there is a significant amount of capital poised to come into the wealth segment, into private markets, and some estimates are this could be as much as 3 trillion over the next 5 years. So even if you're off by a few $100 billion, it's still a very significant amount of capital. I think the second comment probably would be, I think we tend to look at this through the lens of what we call a whole portfolio, meaning what is the contribution that private markets is going to make in the context of an investor's overall portfolio? How does it impact risk? How does it impact returns? And I think that's really important, because what we're seeing, at least from our vantage point, is that more and more of our distribution partners are making private markets in wealth part of their strategic asset allocation. That process is going to take some time. I mean, if you think about the point around the institutionalization, you know, compared to institutional investors, retail investors today in Europe are sub 2% in terms of exposure to private markets. So this transition is going to take some time, but I think there's a really strong tailwind behind this, even if in the short term there's some challenges.
I totally agree about the use of the word democratization. I've got a few throwaway lines which I won't use about that. I guess two other points. One is kind of why. Why is it important from an investor point of view? Is because, and this is what iCapital sort of set up as a mission, is to give better portfolio optimization to West Point and financial outcomes for a much broader selection of investors. And then the other point is the vast amount of capital required to create a more sustainable real economy. And that's not going to get done by government or by the institutional set. So there's this huge pool of relatively untapped capital that can get access and can get put to work by GPs.
Mm-hmm. Thank you. Oliver, how do you see this phenomenon as LP?
Yeah, as an LP, I mean, we've been active for many years. It's true that giving access to private equity has been there since the beginning. It was only a few US investors 80 years ago. Now it's over 8,000. So the wider access to the asset class has been a long process already. The next step is, of course, the retail pool of capital. I mean, 20 years ago, some of the GPs would hardly pick up their phone when we were calling as wealth manager. Today, not only they are the one calling, but they have dedicated teams to work with wealth managers and to provide access to their funds. So I think the response of the GPs has been very good, and it's probably also a fundraising environment that will be tougher for many of our GPs. And answering this pool of capital is quite key for them. To understand the way wealth management work and what are the challenges for us.
Thank you. Michael, any thoughts about that? Why the stakeholders are moving in this direction?
Well, it's the point was touched on earlier. This wave has been coming for some time, right? If you think of the way private markets have evolved over time, it started really with just families. And then, of course, corporates and institutions started doing private market investing. And then endowments and foundations started getting into it. And then in the 90s, public pensions started getting into it. And so it is just the natural evolution that private wealth is now stepping into this very same space. The difference is monumental, though, when you have billions to invest. Between even a high net worth investor is going to invest $1 million, 2, 5, 10. It's hard to build a very diversified portfolio in private markets. But I will say, if you're thinking of the SAA of the individual investor, public markets just don't give you the exposure you need anymore. It's just large tech companies, and the number of public companies is getting smaller and smaller. So if you truly want diversified exposure to equities, or pretty much anything, I guess, in the world, you need to go into private markets. So it's not necessarily, yes, it's a wave, it's an opportunity, but it's a necessity if high net worth is going to build a portfolio over the long term.
Thank you. Diana, we talk about desirability, necessity of incorporating alternatives into retail investors. But what are the main headwinds that we have to overcome?
Well, I mean, you touched on it just then. If you put yourself in the shoes of a private client, and we all are actually private clients ourselves, the first is scale. Minimums are 10 million for a fund, and maybe, you need 10, 12 funds to build a diversified portfolio. You need 100 million, which is outside the scope of most private investors. So that's point number one. The second is selection, and this isn't just a problem for private wealth, but it's more challenging, is that there's a huge discrepancy between the best and the worst performing managers in private markets, much more so than I think in the public markets. So selection really matters. And actually, for your wealth management client, that's a real challenge. Not only do you have to get your head around a whole load of new strategies, be it private equity, private credit, distress, carve-outs, et cetera, You then have to have the ability to find out who the highest quality managers are in the space. And then even if you can find out who they are, you then have to access them. And I think we'll all know that actually some of the best managers in the space are access constrained, they're hard to access. They really like to work with large institutional smart investors that have been long-term partners and will be long-term partners in the future. So all of those things are challenges for a wealth management client. And not only that, you overlay that with obviously the ability to take the illiquidity and the complexity of capital calls. It's a very interesting asset class, I think we've discussed, but it is one that poses challenges for wealth management clients.
Thank you. Tom, any thought, additional thought about that?
I think it depends on which end of the journey you're looking at. There are a lot of similarities. Are you looking at the investor end or from the sort of the GP end? I mean, the first point is a sort of a kind of a quota headwind, which was raised earlier, is this is not right for everybody. I know probably for the GPs out there, you'd love that to be the case, but it's just not the case. In the way that we look at it from iCapital is really kind of three big buckets of what are the hurdles, and the one is around access. So, which managers, how do you get access? But also, what is a vehicle? Is the correct vehicle type for me as a UK investor, as a European EU investor, as a US investor, et cetera? Because it may not be the same. And then the ticket size and all the rest of it. So that's kind of access. Then process. This is complicated stuff. The process around investing in private markets has historically been based for what I always say is small numbers of large tickets, and so incredibly inefficient processes have been able to survive. If you're going into the wealth channel at scale, you need to have large numbers of relatively small tickets. So you have to figure out the process. You can't be sending subscription documents backwards and forwards to get signed. I spent my career in wealth management, and that's the reality of what it was like in the 90s. So how do you improve processes to a point that they can be efficient? Well, the rest of the world has figured out that technology is something to do with it. And so that's what we've put in place, which is a technology platform where the whole life cycle from marketing, subscription, approval, servicing, capital calls, reporting, etc., sits on a digital platform. And then the third one is education. So we know that the penetration levels are incredibly low, not just at the investor level, but also within the big sort of wealth franchises. There's a classic 80-20 rule. And a lot of that is around education. People need to understand what the asset class is. Again, not just at the investor level, but throughout the kind of the whole channel, the vertical, if you will. And I was thinking about it, and again, I don't like using the word democratization, but if you spent my career in wealth management, if you democratize a product without democratizing the knowledge and understanding, you will have problems down the line. So that's something we should all make sure that we figure out.
Thank you. Making access to private markets more flexible requires GPs to adapt. Where are fund managers welcome in this segment, this market segment?
So I think actually we've seen quite a lot of adaptation from the standpoint of GPs over the last couple of years. And when I think about the types of products that are coming to market in the wealth segment today, whether these are non-traded REITs, non-traded BDCs, LTIFs, there's actually been quite a lot of innovation in the wealth management space to address, I think, what Tom and Diane have touched on, which to some extent is how do you give clients access? I'll just highlight a couple of points that I think are interesting. I mean, I think we've gone from an era where clients were typically seeing investment periods of 8 to 10 years. We're now seeing a lot of demand for shorter investment periods. We're seeing demand for shorter lockups. We talked a little bit about liquidity and understanding the liquidity parameters of a product. It's now very common to see products that will provide liquidity up to, say, 5% of NAV on a quarterly basis. So there's been quite a lot of innovation in this space. I think it's going to continue. And actually, from a GP standpoint, we're often asked, is there sort of one silver bullet to distribute products globally? And unfortunately, for the most part, the answer is no. There's actually a need for some degree of, I'll call it regionalization in the types of strategies you bring. But there are ways that are better to achieve scale. I'll come back and maybe comment on LTIF later, but in a European context, I'd say the LTIF is really gaining traction primarily from a GP standpoint because it is the one way, and the LP standpoint, to distribute private markets in a European context cross-border.
Thank you. Well, private markets, by definition, will never be as liquid as their counterparts. But at the same time, we are demanding the structures that provide some liquidity. So where is the balance between the two forces? And democratization of the markets, or this flexibility of the access is a new trend, but are there any lessons to learn from the past? Maybe Tom, do you want to answer?
I seem to have been positioned as the sort of the Debbie Downer, which is not particularly helpful given the business I represent. There are too many lessons to learn from the past. You know, I have no hair and a slightly greying beard, so I have been around for a while and I've seen them, many of them. I think, the first point is how far does democratization go? And, I have 2 teenage sons, and the UK is, mostly a functioning democracy. We had our moments last year. But there's a reason why my 14-year-old and 16-year-old don't get to vote. So we do need to think about, where down the wealth spectrum we want to go. And the other point is around kind of liquidity, and that's sort of interesting, which is there is liquidity needed? Is it really needed? And how much? And is it real? Is it real liquidity? Is it transparent liquidity? Is it fair weather liquidity? Is it expected liquidity? And everyone imagines that liquidity is the be-all and end-all for individual investor space. And so you end up, potentially you solve for liquidity, but you create other issues, and the obvious one being kind of overstructuring. Do you end up with an end product that is so different from the ultimate exposure that you've kind of lost a lot of what people are investing in, or why they're investing in the first place? So there's a concern to me around, one, the kind of real, true understanding of liquidity. And this may be UK specific, but I'm not so sure. I remember having many conversations with the UK regulator where illiquidity equals risk, especially in the kind of the individual investor space. And if that's the mindset we have, then we're going to try to de-risk so that we can sell this product into that channel, but that's not necessarily the right thing to be doing. So I don't know if that answers the question, but I think we should be thinking sensibly about liquidity, and then, but that's only part of the question around, how far can we go and how far should we go?
Okay. If anyone wants to add something, go ahead, because the time is, we are good on time. Well, Diana, which corners of private markets are more suitable for retail investors?
It's a good question, and I think it points a little bit to what you were saying about private markets isn't always suitable for everyone. And I think it is by nature an illiquid asset class, and that's something that we have to figure out if that's right for the individual. I think, look, UBS, I laugh when I hear the word democratization of private markets, because for a while I wondered what it was until I realized I was in the center of it, and we have been at UBS for the last 20 years. We started our business back in sort of 2001-2 time, and we've been actually offering access to private markets for experienced wealth management clients who qualify as professional. they can access actually the full range of private market strategies through the sort of invention of feeder funds, which allows clients with a much smaller ticket to go into traditional LPGP type structures. So that's those clients. I think we've been pretty involved in the evolution on the perpetual sort of fund shelf as well, which allows wealth management clients to get over one of the key barriers to entry, which is complex capital calls, and they want to put their money in the ground straight away. So that's been an evolution I think we've seen in the last couple of years. I think for the true retail client, though, I think really you're looking at LTIF type structures, and I think, you know, and I think we're going to talk about that in a minute, but we've seen innovation and the rules changing, the regulatory landscape changing, which is going to make those, I think, increasingly flexible and interesting for the retail market as well.
Okay, we are now in a new interest rate environment. Do you think this new environment, well, it's not new, but has changed? It has changed the appetite for alternative investment? What?
Okay. Look, I think whether you're a wealth management client or an institutional client, we're in a different environment, and I think it makes sense for everyone to look at not only rising interest rates, but also a slowing economy, inflation that hasn't really come down yet, and thinking about how that should alter their portfolio, or if it should. I think what we've found today at UBS is actually our clients' portfolios have been better with private markets than without, from a performance standpoint. But actually, I think the question that we're being asked today from clients is probably slightly different, actually, and it's given the correction in the public markets has been perhaps greater than we've seen in the private markets, is there a better opportunity there now, and should clients be orientating their capital into that opportunity? And I think the answer that we give them there is look, you know, even if there is a big repricing of the risk premium in public markets, that opportunity is pretty short-lived often. And actually, if you divert capital out of private markets to do that, you're probably missing the opportunity cost is much greater on the private side, where over the long term, putting money into that space has offered more interesting returns.
Okay, thank you. Michael,
Yeah,
same question.
I was going to say, first of all, when you try and time private markets, you lose. It's just statistically, it doesn't work. I will also add a comment to your point, how low should it go for private markets with the individual investor? If an 18-year-old can open a Fidelity account and buy 100 shares of some random over-the-counter stock, which is incredibly risky, right? I think investing in private market companies that are professionally managed and overseen by GPs is actually a lower risk opportunity set for the individual investors. So I hope this institutionalization of the market goes as far down as it can, and we make it easier for investors. I guess to the point, and we've touched on it a little bit here and there about liquidity and where we should invest and how interest rates are going to impact. I think we should step back and remember that liquidity has to come from the underlying assets. We can have all the most amazing structures in the world. We can say it's 5%, 2.5%, but at the end of the day, you have to provide it. I mean, maybe I'll step on the third rail and talk about what happened in the real estate space recently with someone who gated at 5%. It's because the liquidity, granted, I give them credit, they provided the 5% liquidity, but it creates a ripple effect, because remember, retail investors, as we manage this capital, they act completely differently than institutions. Institutions right now are thinking, wow, what a great time to invest. There's dislocation, vintage years now outperform, I should be deploying capital. Meanwhile, retail is saying, wait a minute, let's hold up, is liquidity there? And so it behooves us on the panel here who are looking at these evergreen or semi-liquid solutions to make sure that at the end of the day, the assets within them are going to provide that liquidity that we need, regardless of how it flows up into the structures and how the clients invest. And that really goes to what are private markets, what asset classes are most suitable to invest in, right? We've seen enough of these now, right? So we can walk over the dead bodies of non-success to figure out what the best balance is, right? Institutions have been doing this for decades, right? They build balanced portfolios of private market investments where if things slow down on the PE side, things pick up on the real asset side. Private credit is a great place to have capital, but the return's not quite there. Even with higher interest rates and floating notes, they're getting a higher return, which is great. But you still need to maintain that balance because even with higher rates in private credit, private equity is still returned. So I think maintaining that balance it makes the most sense. And of course, I'll throw out secondaries as well is a great way to deploy capital. We've seen a lot of semi-liquid products. Some just focus on secondaries, some just focus on co-invest. And I think that balanced approach makes sure you have that liquidity when clients unfortunately ask for it. Do they need it? To your question earlier, they really don't, but they think they do. So you need to provide for it. And that's where the assets come into play.
You asked earlier about, lessons from the past and the mismatch of liquidity basically covers pretty much all of them. Whether it be the daily liquid or daily liquid real estate funds around the Brexit, whether it be bank failures, funding.
I remember the 90s.
Yeah, funding short, lending long. So it's all around liquidity. And one, absolutely agree with your point. It's around the managers understanding that and the market understanding it and not pretending. It's what I call sort of transparent illiquidity. And so, the real estate fund in question, very clear about the gates, and you need to read it and all the rest of it, and it's there. And I'm sure that those organizations that explained that and told it to their clients did a great job in doing that. But I'm also would bet whatever's in my pocket and everything else, frankly, that there are clients out there who saw semi-liquid. They saw open-ended, semi-liquid, monthly in, quarterly out, and they're now wondering why they can't get their money out. And that's why the sort of blow across was not just that fund. And this is, I hate to say I told people so, but I did tell people so. The wealth segment and their investors will move as a herd. And so you had that issue happen, and guess what? You're seeing it impact other semi-liquid products.
But I will say, to give them credit, that fund may actually do quite well, and the gates protect the investor from themselves, right, to some degree, so that they don't make a mistake. It's something institutions wouldn't necessarily do. And I mean, on the institutional side, let's face it, they did it too during the global financial crisis. They all bailed, they managed their liquidity poorly, and they hit the secondaries market, and they lost their shirts, and the secondary firms made a fortune. During the last, well, I don't know what we're going to call the COVID crisis, LPs learned from that, and they didn't sell, right? So we need to your point, we need to educate the end investor. We need to let them know how this truly works and where you can make returns. The whole point is it is or it is less correlated, let's be honest, to the public markets. So they need to understand that and understand why, and pulling out is not the way to get that lower correlation.
That's such a great point. I think the correlation piece is because as the industry structures, products aimed more and more specifically for this client segment and potentially builds in features that are attractive, and around liquidity is a big part of that. There's that risk of kind of overstructuring potentially. And so, what are the key reasons for investing is one is the return profile, but also the kind of portfolio optimization piece. And do we have enough data yet to figure out whether those things really hold together? As in, yes, they're less correlated. How less correlated? I don't know. I guess we'll still get
So we
to
actually
see.
do have the data. So we have the luxury of, we meet with 4,000 GPs a year. So we get access to about 2,800 data rooms And we have downloaded all that data into our database and run all of the analysis. So really, for these semi-liquid products to work, you need two things: data, right? Which means build a diversified portfolio, because the more diversified the portfolio is, the more predictable the cash flows become. And of course, then you need deal flow to satisfy the portfolio construction to get it done. And that's where you need a massive funnel, and you can focus on those few investments that have the most liquidity in them. So I guess the data at the fund level is probably to be determined for these semi-liquid products, but in the private market space, that's a known result.
Yeah, I think I guess it's not really a counter, but my comment would be, given the massive growth in semi-liquid product that has come to market in the last 2 years, and in Europe set to come to market this year, that breadth of data, the depth of data may exist. I wonder around the breadth, and again, you put it in the current environment. But I hope you're right.
Olivier, any
Yeah,
thoughts?
just to add on that, I think with many investors now we see that they are asking about not only why PE, why now, but how, and that has really changed for the last 5-10 years. They are quite knowledgeable about the asset class, so that's quite very optimistic. But that's great for us, and discussions are around what share of secondaries, how much co-investment should I do, what is the real exposure that I need to achieve in my portfolio, and building that with the end clients is value add for them and for the wealth manager. So it's a big responsibility for us, more than just an opportunity, I would say.
Thank you. You said it's a matter of how, so that maybe the LTIF is a big figure on that. Continue with you, and I would like to know, in your opinions, if LTIF will be a big trend for 2023?
Yeah, definitely. I mean, the LTIF, the European Long-Term Investment Fund, has been there for a few years now. The first format is a bit disappointing, I would say. We thought it would reach more investors, but we are quite optimistic with the 2.0 version that is about to be released by the government. So currently working with the lawyers in Luxembourg to have that hopefully ready by Q4. Basically, it will change the game, I guess. First, because it will be doable. I mean, we will be in a position to invest into funds. So today it's only direct, and we'll be able to run the fund-of-fund model. So the diversification will be much better. Second, the eligible investors will be wider. So we'll be able to respond to the needs of a greater number of investors. And yeah, so we're quite happy about the part 2, LTIF part 2, which will be the new format, hopefully by the end of the year on that front.
Thank you. Wes, some question for you?
Sure. I think we share the view that the Part 2 enhancements are important for GPs and LPs. Maybe just a couple of lessons, learned from our perspective. We were an early mover into the LTIF space back in 2018, and I think our view at the time was it will probably take time for any new vehicle to gain adoption, and indeed that did take some time. We did launch 2 funds, one infrastructure, one in PE. We raised just about €1 billion across both of those funds, and I think one of the things that was central to that success was the point that, Tom, you made earlier, which is education. So launching a product is wonderful and the returns are wonderful, but if you do not dedicate the time, not only around the design, but the narrative and the messaging and the content and the training and the follow-up, you don't get the best results. Conversely, when you do invest the time and you partner together with your distribution partners, at least our experience has been, you get a much better outcome. And that education process is definitely iterative, is not a one and done thing. We focus on this on an ongoing basis. We work very closely with Tom and team and others, but this is really core to what we're doing. We will bring 2 more to market this year, one of which will be fully funded because, as Tom mentioned before, there are still a significant part of the market that either can't or doesn't want to handle capital calls, and therefore we see that there really are two markets: those who can handle and want capital calls, those who cannot and are willing to tolerate some cash drag in the process.
I think kind of just point on that. I think it's kind of interesting because if you look at some of the constraints that we talked about, the headwinds, some of those are at the investor level and some are at the channel level. So things like capital calls, I'd love to be corrected, but I don't think that's at the investor level. It's not the investor saying, no, I really want to give you all my money now and for it to sit in a bank account over the next few years while you invest it. It's actually at the channel level, i.e. it's the advisors, it's the banks who can't handle it. And I think that's probably got to change, or perhaps will change. I would hope will change. I hope will change because iCapital will help them. But that gets me my point back to kind of the overstructuring, which is, we can create products and increasingly I totally understand it and totally get it, the whole value of having a fully drawn down structure up front. But what's the investor outcome in 7 years? When they think that they're getting the best of your buyout strategies and they think they're getting 20% IRRs and they think they're getting 2 times MOICs, but actually when they get their money back and they kind of do the numbers, they realize that actually they could have just bought a BlackRock tracker instead. And so we just need to be kind of mindful of that and figure out what's driving those innovations in the structuring. Is it investor need and investor outcome, or is it a kind of a factor driven by the players in the channel?
Thank you. Any thoughts, Michael?
Yeah, people hate capital calls. I mean, that's pretty universal. I don't know. So I think any structure that people can figure out and push the cash management to people that are better at managing the cash, I think that's success for both sides. I do think the structures need to be as thin a layer as possible because there is so much drag there. I do think, to your point on returns, I do think, to the education point, people need to understand that if you want liquidity, it comes at a cost. And that cost is return. And it's fine, you can get access and you can get exposure to these assets, but you're not going to get a 2 and 25% return on your assets. You have to give up something, and that tends to be return, to shorten the duration of the asset in order to provide the liquidity. It's simple common sense.
I would also add this conversation is already shifting, because if you were sitting here a year and a half ago and your option was deposits at 0, you have a very different environment now. And so the conversation has moved from how do I stretch to get 200 basis points to, well, you know what? Maybe 500 basis points is good enough. Do I need to invest more? And so I think this also goes back to education and conversation. Some clients may be very content just to take, let's call it 5% and call it a day. So I think we have work to do, and I think there's significant opportunities both in private equity and private credit.
Thank you. In the interest of time, we will finish here because maybe we have a couple of minutes for if anyone wants to make a question.
I have a question. My name is Tucci, and my question is to West Lockhart. Did I get that right? Yes. Hello. I'm affiliated with the University of Oxford, and I'm a co-founder at Covest. And I think the bit you said about education is so important. I don't want us to miss it. So my question is, what classes of people need to be educated, and what form would that education take? So in terms of like the delivery mechanism, for example, what would that look like?
Sure. I mean, I can talk a little bit about how we think about it with our partners, and then maybe we can extrapolate and go a little bit broader. So I think when we think about education, we're thinking both for financial professionals. And so we deal with a population, some of whom are very sophisticated and have significant experience selling private markets. And we deal with individuals who are, let's say, less sophisticated and less aware of private markets and want to enroll in our academy. So we have BlackRock has an academy. We spend a lot of time focusing on private markets education, both for professionals, but also for end investors. We are typically a little bit less involved in the end investor education. We tend to enable the financial professional to do the education. Having said that, we are asked to come and present to end investors. I think if you want to extrapolate further, and I'll maybe pass it back to Tom, who also spends some time on the education front, how do we help educate investors at a much younger age to think about financial literacy, why is investing important, and in that context, what role can private markets play?
Thank you. Yeah, I mean, we do a lot on the education space. We have a collaboration with Kaya, so have created content which we make available, video content, plus sort of tests, if you will, at the end. And I always think about this from the wealth manager, similar to West and BlackRock. You know, our initial user, if you will, from the downstream, if you will, in our platform is the advisor and the product teams within the UBSs of this world, the advisors. And I always think there is kind of to use Americanism, there's offense and defense. So there's offense because clearly you want your financial professionals to understand not just the asset class, but also the specifics of the products and the investment exposure that they're explaining to their clients. There's also the defense, which is, as a franchise, and I ran wealth franchises, you need to know that your people have been trained, that they understand what they are doing. Because, you know, mis-selling or perceived mis-selling or the accusation of mis-selling in, quote, retail or individual investor financial services is the number one hurdle or thing that people trip over. So we've got to fix that. As I said, you know, so that's one of the things we do. We also do asset class training. We do material on individual products. I think probably the biggest in the way that we do it. So rather than we don't go direct to individual investors, we go through financial services firms. I mentioned earlier the 80-20 rule. For this business really to expand, one of the easiest way of doing that is to make inroads into that 80% of the bankers, advisors within any franchise that aren't engaging. And they don't engage because they don't understand. I started my life as a private banker, and I can tell you, and I ran private bankers, people are not going to explain and pick up the phone to clients and investors if it's something easier to do. If they can talk about a mutual fund or they can talk about something else or lending. And so if you want to expand the exposure, which I think we all probably agree is the right thing for the financial outcome for the investor, then you've got to convert the people who are talking to them about the product.
Thank you. Well, we're finished here. Thank you, Olivier. Thank you, Michael, Diane, West, and Tom. Thank you very much for your attention.